Hello, fellow investors. Have you ever felt overwhelmed by the ups and downs of the stock market? Ever found yourself lost in the labyrinth of numbers, charts, and trends? Well, you're not alone. The world of market trends can seem like a foreign language, a dance of digits and diagrams that's hard to decipher. But here's the good news, it doesn't have to be that way. Understanding market trends is like solving a complex puzzle, and once you learn the rules, the picture starts to become clear. Today, we're going to demystify the process of analyzing market trends. We're going to unravel the threads of this intricate tapestry, empowering you to navigate the market with confidence and clarity. We'll dive into the types of market trends, explore the tools and techniques of trend analysis, and talk about the importance of patience and discipline. So, buckle up and get ready for an enlightening journey. Today, we're going to demystify the process of analyzing market trends. The first step in our journey is to identify the different types of market trends. So, let's break them down, shall we? Picture this. The market is a vast ocean, and the trends are the currents guiding your investment ship. We start with the bullish market, aptly named after the charging bull. In this scenario, the market is optimistic, prices are climbing, and investors are confident. It's like a sunny day at sea, where the winds are in your favor and you can set full sail. Next, we have the bearish market, named after the bear with its powerful downward swipe. This is when the market isn't so sunny. Prices are falling and pessimism is in the air. As investors, it's like navigating through a storm where cautious steering is needed. But what if the market isn't rising or falling significantly? That's when we have a sideways market. Here, the prices move within a narrow range, showing indecision among investors. It's like sailing in calm waters with no wind to guide your ship. Not necessarily a bad thing, but it does require a different strategy. Now you might be wondering, why the animal references? Well, they're more than just metaphors. They're a part of market lingo, and understanding them can help you make sense of market commentary and discussions. Remember, these trends don't exist in isolation. They're part of a larger market cycle. Think of it as different weather conditions on your investment voyage. You'll have sunny days, storms, and periods of calm. Each requires a different approach and strategy. But here's the thing, just as a good sailor understands the sea, a savvy investor understands these market trends. They know when to go full sail, when to navigate cautiously, and when to wait for the wind. So what's the takeaway here? Understanding these trends is the key to navigating the stock market. It's not about predicting the exact weather, but about knowing how to sail in different conditions. After all, as the saying goes, a smooth sea never made a skilled sailor. And the same applies to investing. One of the most commonly used methods to analyze these trends is technical analysis. This is the art and science of reading a market's past performance to forecast its future behavior. It's like being a detective, sifting through clues to solve a financial mystery. At the heart of technical analysis are the historical price and volume data of the market. These raw numbers might seem daunting at first, but with the right tools, they become a treasure trove of insight. Let's start with moving averages. Imagine you're on a bumpy road trip. The road represents the daily price changes. It's full of potholes and sudden turns. Now, the moving average is like a smooth path that runs alongside this road. It smooths out the price data, making it easier to spot the overall direction or trend of the market. Next up, we have the MACD, or moving average convergence divergence. This tool helps us identify potential buy and sell signals. It does this by comparing short-term and long-term price trends. When the MACD line crosses above the signal line, it could be a good time to buy. Conversely, when it crosses below the signal line, it might be a sign to sell. Another important tool is the RSI, or Relative Strength Index. This is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100. Typically, an RSI above 70 indicates that a stock might be overbought, and below 30 suggests it could be oversold. It's important to remember that these tools are not crystal balls. They won't always predict the market's moves with perfect accuracy. However, they can provide valuable insights and help us make more informed investment decisions. In essence, technical analysis is about identifying patterns and trends in the market data. It's about using these patterns to anticipate potential future price movements. It's not foolproof, but when used correctly, it can be a powerful tool in your investing arsenal. These tools guide our investment decisions, and with them, we can navigate the highs and lows of the market with greater confidence and clarity. Opening. Another crucial aspect of trend analysis is the use of trendlines. In the fascinating world of market trends, trendlines are like the compass guiding us on our journey. These lines, drawn on a price chart, connect the highs and lows of a stock's price movements. They provide us with a visual representation of the trend's direction, be it upward, downward, or sideways. But trendlines do more than just show us the way. They help us identify support and resistance levels, pivotal turning points in the market. These levels offer key insights into potential entry and exit points for our trades. If a stock price bounces off a support line, it might be a good time to buy. Conversely, if it hits a resistance line and starts to drop, it might be time to sell. Now, let's broaden our perspective beyond the charts. An astute investor knows that while technical analysis is vital, it's only one piece of the puzzle. We must also consider fundamental factors that influence market trends. Just as a doctor checks a patient's vital signs to assess their health, investors use economic indicators to gauge the health of the economy. These indicators include factors like gross domestic product growth, inflation rate, and unemployment rate. For instance, robust GDP growth often signals a healthy economy and can lead to an uptick in the market. On the other hand, high inflation or unemployment rates can cause market jitters, potentially triggering a downturn. By staying informed about these factors, we can get a better sense of where the market might be headed. Remember, it's not about having a crystal ball to predict the future. It's about interpreting the data available to us to make informed decisions. We must remember that markets are dynamic, influenced by a myriad of factors. Trends can and do change, but armed with the tools of technical and fundamental analysis, we can navigate these waters with greater confidence. By staying informed about these factors, we can anticipate potential market movements. Now let's talk about the importance of staying disciplined and patient. Investing is a journey, not a sprint. It requires a steady hand and a calm mind. The most successful investors are those who approach the market with discipline, making strategic decisions based on careful analysis rather than emotional reactions. Discipline is about sticking to your investment plan, even when the market fluctuates and doubts creep in. Patience, on the other hand, is about understanding that success won't happen overnight. It's about giving your investments time to grow and compound, resisting the urge to constantly buy and sell in pursuit of quick profits. Just as a tree takes time to grow from a seed into a towering giant, so too do investments need time to mature and deliver significant returns. The importance of patience and discipline in investing cannot be overstated. Without discipline, you risk making impulsive decisions that could jeopardize your financial future. Without patience, you might sell your investments prematurely, missing out on potential gains. A disciplined and patient investor is like a seasoned sailor navigating the stormy seas. They don't panic when the waves get rough. Instead, they stay calm and stick to their course, confident that the storm will pass and clearer skies will eventually prevail. This mindset is what separates the average investors from the great ones. It's what allowed Warren Buffett to build one of the most impressive investment portfolios in history. It's what has helped countless ordinary individuals achieve extraordinary financial success. As we navigate the complex world of investing, let's take a leaf out of their book. Let's approach the market with discipline, making informed decisions based on careful analysis. Let's be patient, giving our investments the time they need to grow and compound. Remember, investing isn't a get-rich-quick scheme. It's a long-term journey that requires patience, discipline, and a strategic mindset. So next time the market fluctuates and doubts start to creep in, remind yourself of this simple yet powerful truth. It's not about timing the market, but rather time in the market. Remember, analyzing market trends is not about predicting the future with certainty, but rather about making informed decisions based on data and analysis. We've journeyed through the labyrinth of market trends, from the bullish, bearish, and sideways markets to the tools and techniques of technical analysis. We've drawn trendlines, explored economic indicators, and emphasized the importance of patience and discipline in investing. Each piece of this puzzle is a stepping stone to becoming a more informed and strategic investor. So take these insights, apply them, and let's continue to demystify the world of finance together. If you found this video helpful, please do us a favor and hit that like button. We encourage you to share your thoughts and questions in the comments section below, and don't forget to share this video with others who might benefit from it. If you're not already a subscriber, join us by hitting the subscribe button and ringing that notification bell. This is George Asigo signing off. Take care and see you in the next video.